Okay, so as I said, this topic will be about risk money management and trading psychology. It's gonna be presented by me and by Aaron. So let's get started. Okay, so these are the topics that we're gonna talk about: introduction, gambling versus educated betting, types of risks, ways of risk management, money management, and position sizing, which is very important. Important evaluation metrics to evaluate yourself or your strategies. And we're gonna talk last about trading psychology. So what is a risk? Okay, to start with, a risk is a potential of involving danger, harm, or loss. So when we do something risky, there is a probability that something bad or dangerous will happen. Okay, now in finance, it's the chance to lose money. Okay, so or that it will differ from the expected outcome or return. Okay. Now, why do we take risks? We take risks because we believe that the reward will outweigh the risk. So when you, for example, do skydiving, you know that there is a high chance of you dying. Okay, but you do that because you want to feel the pleasure of the reward, of the profit. So when you go also in stock market, you put your money at risk, but at the same time, you think that the reward will outweigh the risk. And today we're gonna learn how to manage these risks to be able to reduce them. Okay, so want to reduce the risk and to maximize our reward. Therefore, as I said, we want to know the probability of the risk, see if we can take it. Okay, so not always we have to trade, guys. Sometimes you shouldn't trade. So we're gonna see how to calculate the probability of the risk, see if we can take it, and try to reduce it, as I said. So now let's talk about educated betting versus gambling. So what is gambling? Gambling is the act of gambling money on something unpredictable. Okay, so it's an unpredictable event. Whereas educated betting is also gambling, but it's on an event that you perceive a positive expectancy. And we're gonna talk about what is expectancy. Okay, for example, guys, playing in casinos have 100% negative expectancy. And expectancy is like expectancy can be positive or can be negative. We're gonna see that. When it's negative, that means that on the long run, you're gonna lose money. And all the games in casinos have negative expectancy. So actually, who made these games made them in a way that they have negative expectancy. And that's why you don't see a casino close or go bankrupt, because they never lose money. So let's consider you have these two stocks. Before we start, let's take this as a motivation. Consider you have these two stocks, one ABC at $20, okay, and XYZ at okay, at 1 second, guys. Okay. I'm gonna try to do like a poll now to see if we can, if you can answer this. So I want to ask you guys, if we have these two stocks, ABC at $20, XYZ at $10. Now ABC, we have 60% that the price will increase to $23. Okay, so you have to buy this stock. You have to buy one of these, either ABC or XYZ. And it has 40% chance that it will go down to 13. Okay, XYZ is at $10. It have 40%, 16, or to go up to 16, and 60% to go down to 80. Let me see if I can do a poll. Okay, guys, I think you can now see the poll. Yeah, you can now see it. Okay, I'm gonna close the poll after 1 minute. Okay, we won't wait 5 minutes. Okay, 30 more seconds. Okay, 10 more seconds. Okay. So we have around 47 answers to buy XYZ and 7 answers to buy ABC. Now let's see which is the best thing to do. Okay, so let's see over here. So although ABC have a bigger chance to go up, let's calculate the expectancy, okay, which is the expected value that you know from probability and statistics. So the expected value of ABC is, it's here $3 over 20 because we calculate in percentages, okay, multiplied by 0.6 minus, because it's a loss, $7 here, so it's 7 over 20 times 0.4 for 40%. It's a negative expectancy minus 5%. Whereas XYZ, as you see, its answer is 12%. Okay, therefore XYZ is a better stock to buy. Okay, and even if you don't have XYZ, you shouldn't buy ABC because it have negative expectancy. So as you see, guys, it's not always that if the probability is high that you should yes, Michelle, I calculated it in percent. It's better than calculating it in dollars. So as I said, you have to see the expectancy rather than the probability to go up. Okay. So now how to know these percentages? It's from your strategy. If you recall, for example, in the Bollinger Bands in the last lecture, when it touched using the third deviation Bollinger Band, when it touched the upper band, for example, the price or there is a probability 99.97% that it will bounce down. Okay, so you can get these percentages depending on the strategy you are using. Now let's take into consideration, like let's do something fun. Let's see the American roulette, okay, which is in the casino. To play American roulette, you have to bet on a color, okay, and then you put a ball and spin the wheel, and if the small ball it will stop on a color. You can also bet on a number, but let's say we are betting on a color now. So either red, you bet on a red color, or on a black color, or on a green color. So it's there is a total of 38 over here. Okay, 18 are black, 18 are red, and 2 are green. So the probability to get green one, it's 2 over 38. Black is 18 over 38, and red is 18 over 38. Now let's calculate the expectancy of this game. So again, we're calculating in percent. So let's say you are putting 100% of your money, which is what you're gonna put. So to be able to gain money, okay, let's say you are betting on red, okay. So red, its probability is 18 over 38, so it's 100 times 18 over 38 minus the black, 100 over 18 over 38 times 18 over 38, and the green one is minus 100 times 2 over 38, and you get a minus 5.26. So it's a negative expectancy again. So what do I mean by minus 5.26? So sometimes, guys, you may win in this game, sometimes you may lose, but on the long run, as the number of times you play tends to infinity, it's as if you are losing 5% on each time you are playing. Okay. So that's why you should not play this game, for example, at all, because you have negative expectancy. So on the long run, you're gonna lose. And even if you play it, for example, if you won the first time, you have to stop. Okay. Now the stock market. The stock market, guys, we have to make our own game. Okay, it's different than the casino. Well, let's go back to the casino thing. Now, the casino who put this game, okay, he have the positive expectancy and we have the negative expectancy. So he's gonna always be the winner and we're gonna always be the losers. In the stock market, we're gonna do the opposite. We're gonna make our game. Okay, we're gonna make our strategy which have positive expectancy. As I told you guys, the stock market is a zero-sum game, which means that every dollar you win, someone else is losing, and vice versa. So you have to make your own game in order to be the winner. Okay, so your strategy must have a positive expectancy. Okay, and you need more than one strategy for sure to account for various conditions. Let me give you an example. So imagine that you have an ice cream shop. Okay, you're gonna make money in the summer more than in the winter. Okay, so what you're gonna do in the winter is you're gonna open another shop that sells umbrellas, for example. So in this way, you can make money in winter and in summer. Now, the same thing in the stock market. You have to have more than one strategy to account for conditions. So not always the strategy work in this time. Okay, it needs specific conditions, and we're gonna talk about this in the next workshop. It will be about strategies. Now, the types of risks and the ways of risk management, Mr. Aaron will talk to us. Okay, so Aaron, if you please.
Yeah, thank you, Marwan, so much for the introduction and everything. I'll get into explaining some of the types of risks we see. So, can everyone see it clearly? Okay, so as types of risks, we have two main types, which are systematic and unsystematic. The first type is called systematic. It's undiversifiable risk and it's market risk. It's basically the risk of being in the actual market, and it's inherent to the entire market or to a market segment. So it affects basically like the entire market at large when it's a market crash, or the entire like oil market whenever a geopolitical war or something happens, like an OPEC decision. So it affects the market at large. And this is undiversifiable, like you can't diversify to get away from it. You have unsystematic risk, which is diversifiable and specific. It's very specific to one single thing, and it affects only one company or industry or something. So, say you own some Apple stock, and news comes out that I don't know the CEO resigned, or the CEO is the target of like a sexual abuse scandal. So this is unsystematic risk. Like you can't plan for this. You can't try to do anything except diversify your holdings, and it only affects Apple, so it won't make the share prices of Amazon go down, for example. Or say like a fire happens at one of the factories, or one of the factories blows up, or I don't know, there's a problem. So this is unsystematic risk. As for risk management, we have many different ways of managing our risks. The first one is called risk acceptance. It's very simple. It's basically we take the risk and we accept it. So say you're buying this like risky stock and it costs $10. It's like a penny stock that moves around a lot. So there's the risk that it might go to zero, the company might go bankrupt, but you still think that it has enough upside that it justifies your risk. And you just accept the fact that there's a risk, but you still go ahead and buy it. So that's acceptance. You have something called risk avoidance. It's when you see that the position is very risky and the risk outweighs the actual reward. So you're like, no, I'm dropping this. I don't care. It's too risky for me to be inside. And I don't think that the payoff will be what I expect it to be. So this is something you do very often as a trader. You have risk limitation. It's a way to actually limit your risk. This is in the form of like stop losses or profit taking when you start putting values that are a little bit above or under the price. So whenever it touches those values, you just get out or get in of the stock. And you think it's unlikely that whenever the price reaches there, it might go back again. So this is the thing you see a lot of like people in sales and trading use. You see a lot of professional traders use this. It's a way to sort of be protected when it comes to price. And finally, you have your risk transference. So risk transference is a way where you pay someone to hold the risks for you. And this is not very accessible to us as novice traders. It's a lot more for the very professional people. And we see this all the time happening in the US, things like contract default swaps, where you take a bit of money and you start paying that payoff to everyone for a month. So they take away your risks for like a bond default, which is what we saw in the movie The Big Short, if everyone's seen it. So it's a way to where you start paying a lot of money to let someone else handle the risk for you. So in case like a bond doesn't it gets defaulted or it loses its value, that person is still covering your money, but you pay something called an insurance premium. So this is what we do as humans for insurance when you go ahead and you buy like a car insurance, but it's very different when it comes to stocks and it costs a lot more money. I'll move back over to Marwan to explain some of the money management and position side sizings. Thank you so much.
Okay, thank you, Aaron. Okay, so as you see, guys, it's not always that you have to trade. Sometimes you have to avoid the risk. Okay, not always we have to trade. Okay, and the best way, as Aaron said, is to risk limit, okay, to limit your risk. Okay, which is the most used by professionals, because risk transference actually isn't that very sustainable, because you're gonna pay like a big percentage of your profit to the one who took the risk off your back. Okay, so we're gonna talk now about money management, okay, and position sizing. It's a part of also risk management, but we're gonna be more specific on how to manage the risk. Okay, so let's talk more about it, and you're gonna remember some things that I said in the previous workshops. So what is money management? Money management is concerned with our entire account, okay, or portfolio, okay? How much money we should put in each stock and how much loss we can accept, okay? So when you go and trade, like why I should buy 100 stocks, not 50, okay? And where to put my stop loss, for example. Okay, so now we're gonna in money management in this section we're gonna see that. Now first, let's see why it's important to manage our money, our account. Let's see over here. Okay, so here is the percentage of our account lost. Let's say that initially we have $10,000 in our account. So here it's minus 20, so we lost 20% of our account, let's say. So we went from 10K to 8K. If we went from 10K to 8K, in order to go back flat, which means go back to the initial amount of my account, that is 10K, I need now 25%, okay? Because 25% of 8K is 2K, and 2K plus 8K is 10K. So if I lost 20% of my account, I now need a profit of 25% in order to go back to the initial position, which is more. If I lost 30%, now I need 43% to go back. If I lost 50%, like if I now have $5,000, I need another $5,000 to go back to $10,000, so it's 100%. And if it's 60%, so it's 150%. As you see, guys, as more as you lose from your account, it becomes harder and harder for you to go back to the initial position. Now, if you lose 20%, okay, it's still like not very hard to go back. Okay, 30% is somehow hard. Now 50 and 60% is nearly impossible. Okay, because if you already lost 50% of your account, okay, it's very hard to go back and win 100% to go back to the initial account. So it's like 50 and 60%, it's impossible to go back. Okay, so we don't want to be in these zones. Even we don't want to be in the 30% zone because it's very hard. Okay, so let's see what we're gonna do. Therefore, guys, as I said, we should not lose more than 20% of our account. Never. Okay, since more than that, it will be nearly impossible to go back. And some money management rules before we continue. maximum risk position you should take should never exceed 5% per one trade. Okay, so let's say I bought some stocks of Apple, the maximum risk shouldn't exceed 5%. What I mean is that I shouldn't lose more than 5% of my account on one trade. Okay, this يعني 5% is the maximum. Okay, if you do less, it's more better. So what professionals do, okay, is that they don't lose more than 2%, okay, of your account. Why? Because there is a high probability that you're gonna have 10 consecutive losses, a streak of 10 consecutive losses. And if on each one you lost 2%, they will add up to 20%, which is our maximum that we want. Okay, we don't want to lose more than that, because more than that it will be impossible to go back. Okay, so you have only to take 2% risk of losing 2% of your account on one trade. Okay, if you have a small account, 2% is somehow hard, so you're obliged to hire it for 5%. Okay, but if you have a big account like $10,000 or more, it's better to take only 2% per trade. Okay, so again, guys, we only, the maximum loss we can take per one trade is only 2%, because we want to account for the 10 consecutive losses, which if happened, it will be 20%. And there is a probability that that happen. Okay. Okay, so that's why we're gonna now talk about position sizing. So it's basically how many shares you should buy depending on the risk and money management rules. So why buy 100 shares, not 1,000? Why not 50? Okay, we have to know the exact amount of shares we have to buy. And we have different methodologies for different situations and strategies. Okay, so we have many methodologies in order to do position sizing. Okay, we're gonna discuss the simple position sizing in this workshop, okay, which is the most usable. Okay, yes, we're gonna see that. You're gonna see that. Okay, so we're gonna talk about the simple position sizing, which is the most used by professionals. Okay, and it's simply a formula. It's a formula that will calculate for us how much stocks we should buy. Okay, it can be stocks, it can be forex pairs, cryptocurrencies, anything. Okay, so basically the formula is the position size, which is the number of shares you're gonna buy, is the maximum loss willing to take on one trade, which is, we said, 2% of our account, divided by the amount of loss you can take per share. We're gonna see that, which basically is the difference between the buying price and the stop loss. We're gonna see that on an example, so don't worry. But remember this formula, max loss per trade, divided by the amount of loss you can take per one share. So let's take this example that will make us understand. So let's say now we have a 100K account, we have $100,000. The maximum loss per trade, as we said, is 2%. So it's gonna be 2K, okay, depending on the money management rule. Okay, so we want to buy, let's say we are at this point over here. Okay, as we said, guys, we are trading this channel, if you remember from the previous lecture, and we want to buy at this line. Okay, and you shouldn't, as I said also last lecture, you shouldn't send an order at the round number. You usually put it above by little. Okay, so okay, anyways, so let's say we are sending our order over here. Okay, we want to know how many shares we have to buy. Okay, so the maximum loss is 2K, and let's say I want to place my stop loss on the 0.8. So I will say that I'm gonna buy here. If the price went down, okay, maybe there is a chance that it will retest and go back, as I said last lecture. But if it broke the line of 0.8, okay, things is gonna continue going down. Okay, so what you do, you want to stop your loss. How did you know it's 0.8? You can use many things depending on your strategy. Maybe there is a resistance or a support over here. Maybe مثلا this 0.8 should be here. Okay, so this is another support. As you see, these are two lows. If it break this, we're gonna stop. Okay, but let's now, for simplicity, I don't want to make the numbers very complicated. Let's say our stop loss is at the 0.8 level, and I want to buy at the $1. Okay, so how to calculate how many stocks we should buy? Using the previous formula, so the buy price is at 1, the stop loss is at 0.8. So the maximum loss per share is 1 minus 0.8. It's $0.2. And the position size, so the position size will be $2,000 divided by 0.2. It's 10,000 shares. Okay? So we have to buy 10,000 shares on this stock over here. So I send an order to buy with 10,000 shares. Now here you're gonna ask yourself, the money invested is the number of shares times the price. Now the price here is $1, as you saw in the previous chart. So the money invested is $10,000. And you're gonna say, isn't that very high? No, it's approximately 10% of our account. It's not actually very high, because the maximum, if you put $10,000 or if you put $30,000, okay, the maximum loss is $2,000. It's fixed. Okay, so don't think that this is very high. Okay, and as you see, let's say if you take this stop loss down, okay, so the stop loss here is negatively is inversely proportional to the position size. So if we increase the stop loss, which is make it wider, okay, this one will go down. Okay, so the number of shares will decrease. So they will balance each other out in a way that the maximum loss will remain 2% of your account. And guys, this is very important to do, that many people don't do, and that's why they lose money. This is the essential thing that you should learn from risk management. Without this, you're gonna lose a lot of money, and it's gonna be impossible for you to go back. Okay, and even if you are doing paper trading, you should practice on this. So a lot of my students or people that I know, they say, we are doing paper trading, why we should bother ourselves with calculations? No, in paper trading, you should be ready for the real thing in the future, okay, when you put real money. So you have to practice on this, okay, on calculating this, on knowing where to place your stop loss. So always, even if you are doing paper trading, you should do this. So I hope you wrote down the formula. It's position size, the maximum, the percentage of account you can lose over the maximum loss per share. Okay. Now let's talk about the important evaluation methods or metrics, which are very important for you to evaluate yourself, okay, or your strategies. Okay, so let's say I traded for a month. I want to know, how did I do? Did I do well? Is there something that I need to improve? And if there's something that I need to improve, what is this thing that I need to improve? Okay, so we're gonna see, and also we will see if this strategy is good to use or it's bad to use. And if it's bad, you're gonna see, using these evaluation metrics, how to improve it, for example. Okay, so let's start. So the first metric we're gonna talk about is the batting average. Okay, the batting average is simply the probability that the trader is right. So what does that mean? This means of the number of profitable trades over the total number of trades. So let's say I made 10 trades, 7 of them are profitable. So my batting average is 7 over 10, it's 70%. So I'm 70% right. Okay. Now note here, guys, there is no batting average above 85. Okay, even 85 is very high. Okay, you're gonna see batting averages of 80, 75, even 60 is very good. Okay, 60 is very good. Any person who tells you that his batting average is like above 85, I see some people on Instagram which send me private messages to give them my money in order for them to trade for me, and they have 100% batting average and they never lose. Okay, this is not true. It's a total lie. Okay, if I know the most professional traders, they somehow reach the 85%, no more. Okay, so this is about the batting average. Another metric is the win-loss ratio, which is also very important. Now, the win-loss ratio is the ratio of profitable trades over the losing trades. So it's the average of profitable trades over the average of losing trades. Don't worry, we're gonna see an example of how to calculate it, and we're gonna see how to read it and what it can tells us. Okay, so let's take this example. I've been trading on a certain strategy for 10 days. Okay, so guys, as I told you, these metrics can be used to evaluate yourself or can be used to evaluate a strategy you are using. So let's say in this case, I had a new strategy and I want to evaluate it. Okay, so I made trades for 10 days. Okay, and here are the results. The first day I won 5%, the second day I lost 4%, and note here, let's say I have $1,000 or $100. The first day I won 5%, which is so $5. The 4%, let's consider it from the initial $100. Okay, so here -4, it's because we have $100, it's -$4. Okay, so calculate this percentage depending on the initial amount of money, not on the money that we have after the first profit. Okay, so as I was saying, the first day it was 5% profit, the second loss of 4, third day 8% profit, fourth day -6, fifth 4, sixth day 5%, seventh -7, eighth -4, and ninth -2, and 10th 1%. Okay, so some days are profitable, some days are losses. Okay, so let's calculate. Let's see. So the total return. Okay, so if we calculated the total return, okay, it's the profits minus the losses. So it's 5 minus 4 plus 8. So it's gonna be 8% at last. Okay. Now the average return will be 8%. I'm meaning that this percent, 8% over 10, because it was 10 trades, and it's 0.8%. What do I mean? Like, it's as if every day I won 0.8%. Yes. Now the batting average over here, guys, is the number of times I was right divided by the total number of times. So what are the number of positive trades? It's 1, 2, 3, 4, 5, 6. So it's 6 over 10. It's 60%. As I told you, 60% is very good. It's considered to be good. Okay, so till now, guys, I see that this strategy is good. If someone sees that this strategy isn't good, let's continue and see. Okay, so let's calculate even more metrics. So let's calculate the average win and the average loss, because we're gonna use them to calculate the win-loss ratio, right? So the win-loss ratio is the average win divided by the average loss. What do you mean by the average win? Is the summation of the one divided by the number of winning trades. So as we said, we won 6 trades. The summation of the percentages divided by 6 is 4.5. Now the average loss over here is the summation of the losses divided by the number of losses, which is 4, which gives us -4.75. Now the win-loss ratio is the one over the average win over the average loss, which is 0.95. Now this metric is less than 1. Okay, this is very dangerous. So this strategy is very bad. The win-loss ratio, guys, should be always greater than 1, and actually greater than 1.2. Okay, so for a strategy to be good, the win-loss ratio must be greater than 1.2, or else you're gonna be losing more than winning. Okay, now here, although the total return was positive, okay, but we took it for only 10 days. Maybe if we took it for 100 days, the return will be negative, and of course it will be negative. Okay, because the win-loss ratio is less than 1. Okay, so on the long run, this strategy will make us lose money and not gain money. Okay, so these are the metrics. So in conclusion, this is not a good strategy. A win-loss ratio means that the strategy in this case is not good, or if you are evaluating yourself, the win-loss ratio less than 1 means that you are not letting your wins go high. Okay, so you are not being patient. So you have to wait more in order to gain more profits on your winning trades, or you are not knowing where to stop your losses. And you are keeping your trades without a stop loss, for example, or putting a stop loss very, very far away. Okay, so that your losses are being greater than your profits. That's why you will get a win-loss ratio less than 1. Okay, so always, guys, what you should do is you should record always. You should do like a tracking sheet where you record all your trades for a month. Okay, and after this month is completed, you should calculate your batting average, your win-loss ratio. There is also more than these metrics. There is also a metric called Sharpe ratio. Now, we won't enter with that now because it's very somehow complicated and we won't have the flexibility of time. So I advise you to go and search for it on Google after we finish. It's called the Sharpe ratio. It's also a very good metric to use. So as I said, every period of time, like 1 month, you should be recording your trades, even if they are paper money trades, which are fake money. You should do that and calculate your batting average, your win-loss ratio, your Sharpe ratio, and see where is your weakness. Okay, because guys, if you didn't do that, you will never discover your weakness. And if you never discovered your weakness, you won't improve. You will always do the same mistakes. And this is the only way to improve. Okay, so I hope you do that. Now let's talk about trading psychology. Trading psychology, guys, is basically to control your emotions, okay, when you are trading. You know that when you trade, there is a risk of you losing your money. And money means the food on the table, okay? So it's not something easy to lose money. So that's why you will face many different emotions while you are trading, okay? And if you are weak in front of these emotions, they will control you, and you won't follow your risk management rules. You won't follow your strategies, and you're gonna lose money. So that's why we want to know what is trading psychology and how to control our emotions. And a lot of traders don't pay attention to this, although it's more important than strategies and more important than risk management. Because as I said, if the emotions controlled you, you won't follow your strategies nor your rules. Okay, so it's like you have nothing. Okay, it's like you are a gambler now. Okay, that's why trading psychology is very important. Now, I taught you guys about risk management. I taught you somehow about strategies, but I can't 100% teach you how to control your emotions. I can't teach you how to do that, okay? Because you have to do that. With practice, you can control your emotions. So but what I'm gonna do today is I'm gonna show you on the different emotions and biases that you will face, and in this way it will be easier for you. So guys, when you know 50%, when you know what is the problem, you already fixed 50% of the problem. Okay, and that's what I'm gonna do now. Okay, we're gonna talk about these emotions that you will face. And at the end, I will tell you how to practice in order to control your emotions. As I said, this basically, I said this, it plays important role in being a successful trader. Professional traders with advanced, what I'm basically saying here is that the professional traders who loses money, okay, they don't lose money because of their strategies or because of their rules. They always lose money because of their emotions, and you won't see a very professional trader lose money unless his emotions control him. Otherwise, he will never lose money. Guys, if you have a strategy, if you have risk money management rules that you never break, you will never lose money in the stock market. Okay, unless your emotions control you. Now, before we continue, before we can start talking and learning the biases that we face, let's do a small experiment, which is fun. So I'm gonna do again a poll over here, but before, let me explain it for you. So imagine, guys, that you have now a job. Okay, so you have a current job. The contact is basically how much you talk with people or you have contact with people during this job, okay, during working time. The current job is isolated, so the whole time at job you don't talk to anybody, okay, you talk to no one, okay, but the time to reach your job from home to the job is 10 minutes. Now, job A, you have a chance to go to job A is limited, so you have contact with people, but not a lot, okay, but the time to reach there is 20 minutes. Now, job B is social, okay, so there is contact a lot with people during working time, and the time to reach there is 60 minutes. Now, I'm gonna ask you in a poll, what do you choose to do? Do you choose to stay in the current job? Do you choose to change to job A or change to job B? So let me do this poll. Okay, so job A, job B, current job. So I want you guys to tell me what you will do, okay? And we have 1 minute again. By the way, this experiment is done really, okay? So some doctors, I think they did it in the past. Okay, 20 more seconds. Okay, let's take 30 seconds more. Okay, let me actually close it now. 1 second. Okay, more answers. Okay, so I'm gonna close it now. Okay. So we have 27 people said they will change to job A, 18 people said we want to change to job B, 4 people said we want to stay in our current job. Okay, so let's change now some things. Okay, again, the current job now is very social. Okay, but the time to reach there is 80 minutes. You have the chance to go to job C, which is limited. The time to reach there is 20 minutes. Job D is social, okay? And the time taken to reach there is 60 minutes. So let's do again another poll and see what are your responses. Okay. So another poll is open now. Remember, guys, there is no true or wrong answer, okay? It's just what you prefer. Okay, 30 more seconds. Okay, we are not getting more answers, so let me close it now. Oh, we are. Okay. Okay, 10 more seconds. Okay, so I'm gonna close it now. Okay, 10 seconds and it will close. So let's see what do we have here as results. Okay, so okay, so we have 18 people chose to go to job C, 26 people chose to go to job D, four people chose to stay in the current job. Okay, okay, let's see what happened over here. I want to tell you guys, observe job C, D, and A, B. It's basically the same job. So job A here is job C here. Have limited and 20 minutes. Job B is social and 60. Job D is social and 60. It's the same, okay? So job C and job D are the same. But what happened is that in this case, 27 people chose job A and 18 chose job B. But in this case, the numbers are exactly flipped. Job C 27, job C 18, and job D 26, although they are the same jobs between here and here. So what happened? Okay, how what happened with your brain that made you change your job? Okay, so what you did is not logical. At first, a higher percentage chose job A, then a higher percentage chose job D, knowing that these jobs are the same. But I'm gonna tell you what happened in your subconscious. What happened is in your subconscious is the following. What I changed in the two experiment guys is the current job. So I changed your initial position. In the first one, your current was isolated and it needs 10 minutes. The second time, it's very social and it takes 80 minutes. So what happened in your brain? Let me tell you what happened. You thought in your subconscious, you thought in this way. Here, you looked at your current job, it's isolated and it's 10 minutes. Okay. If I went to job A, it's gonna be better in contact, but it's gonna be worse in the time. Job B is the same, more better, but more worse. So what did your brain do? In your subconscious, what did your subconscious do is that it looks on the losses that you are losing and not on what you're gaining. So your subconscious looked here, 10 minutes, 20 minutes, 60 minutes. Okay, so I have not to lose a lot, so I'm gonna choose the 20 minutes. Okay, your subconscious did this. Here, your subconscious did this. On the time you are winning, you are winning. Okay, so 80 minutes, 20, 60. So in here you are winning, but you are losing here. So if you went from here, you are losing a lot from very social to limited. It's more loss than from very social to social. So your brain wanted to reduce the loss. So he went to job D. Okay, although job C and D in the both cases are equal, are the same, but your subconscious played the trick on you. And this is the loss aversion bias. It's the bias number one, it's the loss aversion, which is losses have a bigger negative impact than equivalent gains have, and actually 2 times more. What do I mean? I mean that your brain will process loss 2 times painful than an equivalent profit. Okay, so if we want to quantitate this, let's say I want to play with you a game where we toss a coin, and if it's head, I pay you $5,000, and if it's tail, you pay me $5,000. Of course, you won't agree on playing this game. Why? Because you're gonna think that I may lose $5,000, but there is an equal chance taking a fair coin. There is an equal chance to win $5,000, but your brain will process losing $5,000 2 times painful more than gaining the $5,000, and this is the loss aversion bias. Okay, this is the loss aversion bias, and you fell in this bias in this experiment. Okay, because I was able to make your brain do the loss aversion bias and choose to think about losses, although job A is the same as job C and job B is the same as job D. You're welcome. So in stocks, how does this affect us in stocks? Okay, if it's $10, if I bought at $10 and then the price increased to 20, and I still have the stock, then it decreased to 15. Now you're gonna feel pain on the $5,000 that you lost more than pain at the $5,000 you get here. So you start saying, if I sold earlier, I would have saved $5,000. So you take as this level, you take it as the initial point, okay? And you consider this a loss, whereas you are actually still on a profit. And maybe it continues going down, okay? And you are now more in a trouble, okay? So maybe you should take your losses over here, which is actually a profit, okay? And not continue with the loss aversion bias controlling you. Bias number 2 is the endowment effect, which means that we place more value on something that we own than if we didn't own. Okay, so now if I asked you how much you would sell me your phone, definitely you're gonna say a price more than the market price that is being traded at. Okay, because it's your phone, you believe that it's valuable. Okay, so you're gonna put a price more than the usual. How does that affect us in stocks? When you buy a stock, you are instantly under this effect, okay? And you believe that this stock, the price of this stock must go up, let's say, if you bought it. And you refuse to sell it at a specific price because you consider that this price is low to sell it. And you start searching for news, okay, that confirms your belief. And this is what we're gonna talk about it in another bias, okay? Bias number 3 is the status quo bias, which is the comfort zone. Okay, we know it in the comfort zone, which is we prefer staying in our current situation rather than changing it. And this is also proven by experiment. Even status quo is endowment effect, sorry, is proven by experiment, but due to time, I'm not able to tell you about these experiments. Status quo bias is done also, is proved by an experiment. Okay, so how in trading you keep holding a losing stock when you have more than 8,000 other stocks you can go and use. Okay, so like I know many people, why you don't sell the stock, it's going down and you are losing money on it, and he or she tells me that it's gonna go up later. Okay, and he continues waiting and things become worse. Okay, because this is status quo. You are afraid to close your position and go again and start researching again on a good stock. Okay, that's why in a strategy gameplay, which we're gonna talk about, game plan, sorry, which we're gonna talk about it in the next lecture, we must specify a maximum holding period that we should not hold the stock beyond. Okay, so the maximum holding period is 1 month. After 1 month, if it's profitable, if it's losing, we have to stop. Okay, this is the maximum. You can sell before it, but you can't wait after it. Okay, and this is part of the strategy, a rule of the strategy which you have to follow. And if you didn't follow, you're gonna lose. As for in the anchoring effect, which is the common tendency to rely too heavily on the first piece of information you are offered, okay? The anchor. So sometimes, guys, you woke up, for example, you hear that Facebook stocks will go up in price, okay? So khalas, you are now convinced that it will go up, and when you go search for information, you search why Facebook prices will go up, okay? And you start convincing yourself more that it will go up. So it's the tendency to rely too heavily on the first piece of information. And anchoring occurs when individuals use an initial piece of information to make subsequent judgments. So maybe you see another news that tells you that Facebook will drop, but you say, no, this news, for example, is not reliable, it's not credible, okay? The author of this one doesn't understand stocks as the author of the first one. Confirmation bias, it's also linked to the anchoring effect, which is we search information that confirms our beliefs and opinions. So as I said, when we see, for example, first news that stock of Apple will go up, we go and search for reasons to convince ourselves more that the price will go up, okay? So actually, when you hear a reason why Facebook will go up, you should go and search for reason why it will go down, okay? So that you take off this bias. So, and finally, the reason why we have these biases are genes, instincts, and slow genetic mutations. Now, before, guys, in the past, okay, before technology and even before civilization, we have, for example, let's take an example, the status quo bias. Okay, so people used to live in communities, and if a person left the community, he may die because of starvation, maybe a wild animal will eat him. Okay, so people who don't have, for example, the status quo, okay, they used to get out of their from their community and get killed. Okay, but the ones who survived are the people, for example, with the status quo, because they remained together, and they they are our ancestors now because they lived. Okay, so now we have the same genes as them, which is the status quo. We have it by genes because it was responsible for our survival back then. But nowadays, okay, it's something that hurt us actually. Okay. Now, why? Now, because of slow genetic mutation and the rapid improvement of technologies, our genes can't catch up with the technology. Okay, so we need a lot of time in order to get these biases out of our genes. Okay. So this was it, guys. Before we leave, I want to tell you something about how, as I told you first, about how we can train on controlling our emotions. So, guys, if you want to train on controlling your emotions, after now you knew the biases, these are all the biases that you're gonna face. Okay. Now, paper money, paper trading, okay, won't train you a lot on emotions. Why? Because it's fake money. Okay, now it will train you a little bit, but not a lot. So my advice for you is to first do this cycle. Okay, this cycle will make you a profitable trader that I did and that all professional traders do. First, you should learn, okay, and now you learned, okay, and you are still learning. After that, you should paper trade. Why? In order to practice on your strategies and risk money management, okay, and somehow your trading psychology. After that, what you should do is that you should make a real account, but with a small amount of money, okay, not the amount that you want to put, a small amount, in order to train yourself on controlling your emotions. When you feel comfortable enough, you put the amount of money that you need, that you want from the beginning, okay, to trade with. This is, I believe that this is the best process to be a profitable trader, okay? Thank you very much for attending this lecture. I hope you liked it. And next workshop, it will be about strategies. It's also very important. So I hope to see you again. Okay, thank you very much. The floor is now open for questions. If someone have any question about what we talked or any question about anything else, me and Aaron are ready to help you. You're welcome, guys.
Thank you so much for attending, and again, we're open for Q&A now. If anyone has anything to ask.
We're gonna see investing strategies next lecture. We're gonna talk about what is a strategy, basically what is a strategy and how we can do a strategy. And I think I'm gonna also like introduce some strategies for you.
It will be the last session of this workshop. Okay. There's a question. What does one trade mean?
Yes, one trade means يعني one order that you send. Let's say you want to buy an Apple stocks, okay? This is a trade. You consider this a trade, even though it's, let's say you want to buy 100 stocks. All these 100 stocks are considered one trade. Okay, so let's say today I went and I bought 50 stocks of Apple, and I bought also 50 stocks of Tesla, and I shorted 50 stocks of Microsoft. Okay, so basically I made 3 trades. Okay, is that clear? Welcome. Yeah, I get now why you are asking. For simple position sizing, so on one trade, as I told you, you have 3 trades that we did. Okay, on each one, you should not lose more than 2%. Okay, on each one. So I bought stocks of Apple's 50 stocks. I should not lose more than 2% of my entire account on them. The same for Tesla, the same for Microsoft. Each one 2%. Okay, each trade is 2%, the maximum loss that we can hold.
Okay, I'm gonna end the session now. Thanks a lot, everyone. We'll see you in 2 weeks. Next week is off, I think. So we'll see you in 2 weeks. Take care. Bye bye.
Take care. Goodbye.
Goodbye, guys. Thank you for attending.